What's up traders, Tom here with another video. Today we'll be talking about gold, the most well-known metal in the world, always renowned with luxury, wealth, and a hedge against economic uncertainty. In recent years, gold has been underperforming, but is that all about to change? Stay tuned. Before starting the video, I'd just like to remind everybody to, of course, subscribe and hit that bell if you're enjoying our content on the financial markets. And make sure to check out our free public Telegram group if you want to share your trade ideas with other traders around the world. So let's begin this video by talking about the current China-US tension trade war, because I think this is probably the most interesting part of when we're talking about gold and why it could appreciate over the next coming years, even more than it has already done so. So gold has been gaining as, of course, investors seek safety amid US-China tensions. And we've seen this rhetoric for a while now. When Trump threatened higher tariffs on China back in around May of 19, we started to see gold strengthen after that point and effectively break a new high. And this was an incredibly important break for gold. And we will talk about that technically at the end of this video. But this key point was the point when gold shifted from being an underperformer in the market to now a very big overperformer. And now that we're in economic uncertainty again, gold is looking even stronger from this aspect. So let's talk about the lists of countries that actually create gold. Gold's relatively rare from the perspective of it isn't made in huge quantities. It's not a rare metal, but it has always been perceived as a luxurious metal, and it's used, of course, in many jewelry forms, but the main store of it has always been a hedge against economic uncertainty, with many countries holding big reserves of gold. And most people are aware of this. Gold used to be called the gold standard. All of these types of things used to be backed against currency to a degree and then taken away. So gold has always played an integral part of people's ideas of wealth. Now, nowadays you're seeing a movement towards Bitcoin being the digital gold. And while I can see some reasons behind that, at the end of the day, gold is still a tangible metal, and many people and many old school money people will still prefer to hold real gold and gold bullion over digital gold, or whatever that may look like over the next coming years. I think Bitcoin hasn't been tested enough as a store through a crisis for us to understand whether it truly is going to be a massive hedge against uncertainty moving forward. But we will see, and that's just my opinion. So the first kind of myth that I wanted to debunk to a degree, and yes, this is a relatively old chart, is gold's correlation between quantitative easing success and basically gold going up. So a lot of people argue the more money we print, gold goes up. Well, we have to look to the past to a degree to see that. So during QE1, gold did very well. During QE2, gold did very well. During QE3, gold underperformed. So clearly, quantitative easing alone is not enough to say gold is going to go up. Did stocks go up over this time? Absolutely they did. And that was in result of more money being pumped into the system. Where is that money going to go? Gold is scarcity. Gold is about holding against economic uncertainty. So it makes sense that a trade war, or what we're seeing right now with the crisis in the markets and the fear of recessions, is going to start spiking gold. But from a perspective of quantitative easing alone, it doesn't look like the correlation is strong enough between those. The next thing, and the big question, is always been, well, how has gold performed versus the stock market? So here we have four charts. We have effectively silver, which is the silver line, gold, which is the yellow line, and then the two main indexes, Dow Jones blue, and the red one is S&P 500. This is effectively the bottom of the GFC. So we'll call this the QE1 phase. So we have the QE1 phase, and then effectively out of that, we've seen a strong appreciation in the metals. And then around 2011, 2012, we start to see an underperformance of the metals. Now, silver, the key to silver is always there is a huge demand on silver from a commercial industrial standpoint out of a recession, as economics and basically countries start to build and there is a demand on silver. So silver generally performs incredibly well out of economic recessions. You'll notice it underperformed relatively heavily during the GFC though, because it's when the market is falling and we don't see as much demand for the metal. A lot of the metal is actually used in real purposes. So that's why silver underperformed. Gold performed relatively well over that period, and then of course performed amazingly as the markets were recovering. And then as the markets recovered, it underperformed. So let's take a look at this in more detail by looking at this particular chart. And this chart shows us so much about gold. So the key to this is economic uncertainty being taken away. So during the tech bubble crash, we saw effectively as the market was going down here, we saw gold start to recover and start to move higher. And this was a well-known big bullish time for gold. Everyone was going crazy. FOMO was real. People were loving gold. Now, gold appreciated all the way pretty much to the previous peak. And then it had like a bit of a time where it didn't do too much for a couple of years. We saw the GFC, and then gold actually began to spike again coming out of the GFC until the market reached the highs. So if we actually have a look here, when the market reached the all-time high again, it broke through that high, and this is when a huge amount of risk on money came through. People started to understand, well, we're out of the economic uncertainty. Let's go look for some stocks. Let's go buy them. We are now in 10-year bull market plus kind of aspect. That's that kind of money cycle. So when that happened, guess what? Gold started dropping, and it had its multiple years of very lackluster returns. And that is what we generally see with gold. So the key here was when the market made a new high, gold appreciated. Well, that's interesting. So we're starting to feel a bit of a hypothesis here about what may happen again. I actually wrote an article earlier this year where I was saying bulls are returning to gold, and this was happening during the crisis outbreak right at the start. And I basically said, you know, the differences between silver and gold, and more importantly, this similarity. So I wrote this similarity here in terms of when the market peaked in gold and when the market actually broke a new high. And this is the Dow Jones, but the same principle as the S&P 500. If we scroll down, we can see here also that the first major target level on the monthly was where we are starting to approach now. So 17.80 area was previous resistance. And we can see that the peak was around $1,900 an ounce. Now, what do we think is probably going to happen if that level is taken out? Interest is going to come back into gold. Like any market, when new highs are made, articles are written, people get interested, and you see a huge movement towards gold. So if we have increase in trade tensions, and then on top of that, we also have some form of catalyst that pushes it through, e.g. what we're seeing right now, and we have a lowering of interest rates, which to a degree, whenever you lower interest rates, gold will perform better. That is the kind of catalyst that you're looking for. And there's a couple of big billionaire kind of guys that are looking at this, and they are investing in this kind of aspect because they're saying we broke out of the key level of resistance, which was here. Remember, I mentioned that at the start of the video. This is a key level of resistance, absolutely key. When this broke through, everyone was talking about it in the big circles, and there was a lot of trading going on. And pretty much when this break happened, it was fairly sure that it would go to this 1600 zone. In many of the webinars we do, we talk about this. We talked about it all the time over the last couple of years. And then we have seen almost the approach of the 1780 zone. So very interesting what's happening here. And it's happening all like before and like what happened before. If we look at gold versus interest rates, this is just 10-year real interest rates. Again, we see when interest rates were dropping, gold was performing very, very well. And then, of course, when interest rates started to normalize, gold started underperforming. There is a decent correlation with this. But again, the big correlation is uncertainty, like always. And the second correlation with gold is going to be market performance. Because I think when you see new highs, the market will dictate risk on and people's attitudes. No surprise then that we've seen strong gold coming in with weakness since today's news, which was that a vaccine was relatively effective. And if that's true and the market goes and makes new highs, then of course gold will underperform. But most likely what will happen is gold will have a cooler after making a new high. It will come down, it will reach kind of a level of around this 1730 down to around 1720 zone. Somewhere in here it'll find some form of support. And then if we look at the weekly, it will go on to try to test these highs during this crisis period, this 1790, 1780 zone. And then if it is able to make and break 1900, what will happen next is you'll see a massive explosion in gold because it's made a new high. And whenever you see gold make a new high, just like it did during 09, there was a huge explosion in percentage, because this is quite a lot of percentage. When it breaks through here, it breaks through 1,000 and very quickly runs up to 1,200. So that's 20% in only a few weeks. You see a massive increase in gold. And that is what generally happens when key levels are broken. So it's one to watch out for. It's one to look at and analyze and understand things from the past. And whenever I get asked, well, why do you look at this stuff? It's, a heap of mumbo jumbo or whatever. The main reason you want to is you need to have confidence. As an investor, you may have confidence in a stock. Let's say it's Google. Google's a great company. May have some problems over time, but realistically, they make a ton of money from searching and from all these internet businesses that they have. So you may have supreme confidence in Google, and therefore you'll hold Google knowing that that company is always going to make money because you're confident in it. When you're trading something like gold, how can we be confident that gold's going to go up over time? Yes, it has, but it's also had some incredibly poor periods. And one of those things that you want to do is you want to look at gold's return over time, gold's real return over a certain period. And then you want to think, what has happened before? Do I have the confidence to hold this for the period of time that I need to? So hopefully that makes some sense to everybody today. The key to everything is never having FOMO. You always have to look at things from the best investment objective that you can, and you want to look at as much information as possible, but be a realist with it. There's too much information sometimes. So you want to say, okay, what makes sense? And then think about human psychology. If human psychology makes sense to your trade, and it makes sense in a generalized, normal kind of aspect, not like the S&P 500 right now, but it generally will make sense, that is what you want to do. So happy trading, everybody. And of course, remember to like, comment down below, and subscribe and hit that bell if you want to see more financial videos on our channel. Thanks, everybody. Happy trading.